finally guys, HIMS and HRs reporting their Q4 2021 earnings. The stock is pumping after hours, up almost 12%. So we got to dig deep into the earnings report to see what causes this positive reaction. Is it justified? Look at the pros and the cons as always here. Let's go. Hi, if you're new here, I'm Robert. Welcome to my channel. Here we look at stocks from an unbiased perspective, always weighing up pros and cons to find the best possible investments. If you find this content valuable, like and subscribe. But let's keep moving. So we've got the earnings report, the press release here on the left side. HIMS and HRs reports fourth quarter, full year 2021 financial results and provides guidance for the full year and the first quarter of 2022, which is obviously also very important to see. So what have we got here? The headline says exceeded Q4 2021 and full year 2021 revenue and adjusted EBITDA guidance, which is very good to see. Obviously, full year revenue grew 83% year over year to $271.9 million. Q4 2021 revenue increased from Q3 21 and grew 104% year over year to $84.7 million. We've got the member subscriptions growing over 95% year over year to 609,000 subscriptions, providing Q1 and full year 2022 guidance with full year 2022 revenue in the range of $365 to $380 million and adjusted EBITDA in the range of -$30 to -$20 million. So from an earnings beat perspective, on the left side here the Q3 report, on the right side the Q4 report, we had expected for revenue to be in the range of 263 to 265 million, but we actually achieved 272 million, beating basically that higher range of the revenue number to an overall year-over-year growth of 83%, which is very, very strong. Adjusted EBITDA numbers were to be expected in the range of 35 to 37 million loss, but we actually done a 30 million loss only, so 5 million beat there, basically 5 million more profitable than actually expected. Okay, but now let's dig into the earnings report, look at key business metrics and expansion data, but also the financial data obviously. And at the end of the video, we're gonna look at valuation and how it compares to what the earnings report is saying. If you've been following the news on HIMS and HRs in the last few months, we've seen that every month or so we basically had good news coming out for expanding into another store, expanding into another retail store, and this is now visualized here on this graph pretty nicely. You can see that most of what's been announced, what's actually important, such as Walgreens and Amazon and CVS, they're all around the end of 2021, beginning of 2022, with Walmart and Bed Bath Beyond as well. So we do actually have not really seen that impact hitting the revenue figures at the moment, because most of it happened at the end towards 2021. Obviously we had that beat already, but I do expect a much more significant beat going forward in 2022. And I think the earnings estimate, the earnings guidance that the company has released is actually playing into that. So we will see the effect of those 6 to 7 new expansions in 2022. In terms of telehealth consultations, we see an exponential growth for the full year 2021 to 5.2 million compared to last year only 2.8 billion, meaning almost double the amount of consultations we have, showing basically the shift towards that new telehealth model and how the new generations are adopting that model and how they are comfortable with that. That is also reflected in the strong subscription number growth that we've seen. So we're now at 609,000, as we mentioned before, up significantly from the same time last year, almost up 100% year on year. And we can see that every quarter we've been growing quite nicely and had an actually bigger growth than if you compare these same quarters of 2020. Strong growth, and growth is accelerating now with higher subscription numbers over the quarters in 2021. One of the important things is obviously to retain the customers that you've already acquired, the customers that are already subscribing to your business model. You don't want to see them, turning over every year or every month so that the company has to get new subscribers. We want to see that the consistent, what's so-called the cohort of that year, is remaining or is retained as much as possible so that we can build up and get new customers, accelerating and compounding the growth. So I think this is what's visualizing here. So if you look at new revenue, obviously it's also increasing exponentially, but the repeat customer revenue from those increased subscriptions is also increasing rapidly, basically leading to a compound effect here, because we kind of double up our growth because we have an existing base which get more and more revenue from that existing customer base, but we still obviously in a high growth phase. We get new customers here coming in, leading to this massive revenue growth that we've seen in 2021. One of the concerns that investors had with the high marketing and selling expenses that the company still has, what this graph is supposed to show you is that if you started Q1 2021 as a baseline with $20 million paid in marketing expenses, you can see how that increased over time and over the quarters, but how sort of the customer acquisition cost is remaining relatively stable. I mean, it increased a little bit towards the Q3, and then we had a drop in Q4 2021 where they basically didn't spend as much per customer, although the amount of spend was the same as the previous quarter. So they're basically illustrating that it's maintaining the customer acquisition cost. But another question that we have to ask ourselves obviously is whether that customer acquisition cost at this 100% here, whatever the number is the right number. So this is something we have to look into, because maybe they're already paying too much per customer and now we're just saying we're maintaining it. We actually don't know if the maintenance of that customer acquisition cost is a good or bad thing. However, this next slide here is giving us some more insights on whether the customer acquisition costs are too high or not, and whether they are actually improving over time. So what we've got on the left side here is Q1 2019 cohort, which means the people that became customers in that respective quarter versus the people or the cohort from Q1 2021 on the right side, to see how much time did it take us, how many quarters did it take us to actually pay back the amount that we've spent upfront on those customers. And we can see that when we look at Q1 2019, the spend was 12, and it took us almost a year, or actually over a year, to get that paid back. So our previous marketing expenditure was quite inefficient as such. And they're showing now on the right side how this has improved over time, while the spend amount is actually up. So it's now 20 compared to 12 here, but it takes us less than 6 months now to actually get that money back, meaning that every marketing expense, every marketing dollar spent recently in the recent year, in the past year, is actually used way more efficiently, showing that the amount of marketing expense or the increase of marketing expense is not so much of an issue or concern, given that we have a higher, quicker payback period, but also the growth, as we've seen in revenue numbers and subscription numbers, is going up exponentially, showing that what we spent as marketing expenses here was used in the right places to get the right customers to onboard with us. Now we look at the financial metrics of HIMS and HERS, looking at revenue growth, gross margin growth, and EBITDA expansion and other costs for the business. As we can see here on the right side, we have two graphs, one showing the year-over-year growth of revenue and one on the right side showing the gross margin growth over the past 4 years. Whilst on the left side, I've given you the slide from the Q3 2021 earnings just to see as a comparison. So now we can see headline, we had an attractive historical revenue growth and significant gross margin expansion. Now that's been changed to significant historical revenue growth, and gross margin profile translates into attractive gross profit generation. So basically swapping those two words here. But nevertheless, we can see that we have been growing revenue on a rapid rate, now up 83% year on year, leading to a compounded average growth rate of over 117% over the past 4 years, which is extraordinary, obviously. But even more impressive, I think personally, is not the revenue expansion, but the gross margin expansion, the gross margin growth. That just shows how successful, how efficient their business model is. Once you acquire the customers and he will be a continuous subscriber to your services, the margins expand rapidly. Like you can see that we had a 29% margin in 2018 when we didn't have as many subscribers that were buying the products. And then now looking at a 75% margin, consistently, increasing that margin over the years. And we actually see that, from last 2 years, it has been staying around that same number, but it is obviously an impressive number. So I don't really expect it to grow to 100%, right? So at a 75% here, we're looking very strong. That just shows that as more services, as you are having a subscriber and as more products they order, the gross margin expands from that existing base, which just shows how good the gross margin is for those products that they offer. And in terms of revenue, obviously that translates from the key business metrics that we have, translates into strong revenue numbers. We have the high subscription growth, almost 100%. Revenue hasn't grown as much, but that is just normal because obviously some of those old subscribers are falling off, so you need to renew them, replace them, similar to a Netflix or Disney Plus model. So it's still a very impressive growth year over year. And if we look at the revenue growth for the new quarter and the expectations here, we do expect it to grow even more to $91.5 million. So this is the expectations for the first quarter of 2022. So just showing that management basically believes that there's definitely way more room to grow and that the growth trajectory that we see here will just continue in the upcoming year as well. And for the full year perspective, we have the chart here with the full revenue estimate for 2022 being 365 to 380 million, representing a 34 to 40% growth. That's obviously slowing down now from this year. As the company grows and as the revenue figure becomes bigger, the growth basically on a percentage level slows down. But from an absolute figures perspective, you can see that from a 2021 actual figure of 272 to a 365 at the low, we're still looking at a revenue growth of 190 million versus 120 million revenue growth from 2020 to 2021. So revenue is still growing exponentially. It's just the percentage figure as a result of the numbers getting bigger is going down. When it comes to adjusted EBITDA, so the earnings before interest, tax, depreciation, and amortization, we do have something interesting here. So obviously they have surprised to the upside with the actual figures for 2021 with only a $30 million loss, whilst it was more like a $35 million loss expected. But going forward, the estimate here seems a bit rough, so expecting minus 30 to minus $20 million loss. So we have to see why this is not getting much better, why management is still kind of very conservative here. Is it because we're still expanding rapidly and will have a lot of marketing expenses to come? Or is there anything else that is causing this adjusted EBITDA estimate to stay roughly the same? So obviously we don't have that detail of that number to be able to tell. So we'll have to listen to the conference call to see what they say about that, if they mention it at all. But I would have liked to see a bit of a better estimate here, where we are below that 30 million, going more towards, maybe a $10 to $20 million loss range, because obviously we've seen that the marketing expenses were going up, but the customer acquisition cost remained pretty flat, whilst the payback period was rapidly increased. So for that impressive revenue growth expected for next year that we see here, I'm actually surprised that not more of that is coming to the bottom line. So it will be interesting to see what is actually causing this and what expenses in there to cause adjusted EBITDA to remain quite flat. In terms of the actual numbers for 2021, when it comes to the EBITDA reconciliation, so from the actual net loss that's on the financial statement to the adjusted EBITDA figure, one number sticks out pretty badly here. I mean, we do have $107 million loss actually, of which part of that is stock-based compensation. So this has been going up rapidly. So we've definitely seen that there was a lot of expenses made in 2021, a lot of stock options granted to employees and probably also to the influencers that have been supporting HIMS and other parties as well. So this is a rapid increase. We do have to watch that number. This is just insane, because obviously that will mean that future dilution will be in place. At the moment, it doesn't really affect as such the cash flow, because it's just a stock-based compensation, so it's not cash-based compensation as the name suggests, but it does dilute the shareholders at the moment. So we have to be careful that this percentage is not going out of hand, and hopefully we see in 2022 this number to go down. In terms of the revenue breakdown here, we have online revenue and wholesale revenue as sources of revenue for HIMS. We see for the year ended 2021, we're looking at a total of 272 million, as mentioned before, of which 259 is online revenue and around 13 of that is wholesale revenue. And what we can see when we're comparing those numbers to 2020, both of the numbers increased significantly, overall increase of 83%, and both categories increased by around the same number. So as expected, we have the online revenue expansion. Obviously we have already the proven model there, but also going into Amazon right in the last quarter of the year. And we see the wholesale revenue with all those new deals that were announced towards the end of the year. We do see some impact of that growth already happening. And obviously I'm expecting in 2022 that wholesale revenue figure to be quite a significant driver of revenue growth. Although obviously online revenue will always be a strong source, but wholesale revenue is what they're going into now with all the new stores and all the new partnerships they have been making. When looking at the overall P&L, the profit and loss statement for the year, we don't really see any more further surprises as such. We see obviously the revenue numbers and the gross margin in line what we talked about. We do have marketing and selling expenses quite high, basically leading to a loss of $115 million. Of which obviously we've seen significant portion of the selling in general and admin is the stock-based compensation, which is a non-cash item at this stage, but obviously diluting us as a shareholder. So we gotta watch our deadline here when it comes, going forward, as obviously we talked about marketing expenses, we talked about how the payback is getting better and how the customer acquisition cost remains the same. So that means if there's more revenue, the marketing expense should remain quite flat over the year, but the SG&A expenses do include that stock-based compensation, which obviously we don't want to see that high of a number going forward. I mean, this was just an insane number to have over 60 million of that included in here. And this is obviously why you see almost a triple up from the expense in 2020. From a balance sheet perspective, we do see cash going up, short-term investments up as well, leading to a very good current asset number of almost 270 million compared to only 113 million a year prior. In terms of any other long-term debt, we don't really have much of long-term liabilities. Nothing that is significant to be mentioned here, as we obviously have that high cash and short-term investment balance, which we could just use to pay off any sort of debt that we have. From an equity perspective, it's a bit hard to look at this here. Obviously, they did that reverse merger via SPAC deal in 2021. So it's kind of hard to look at the actual capital numbers to understand what's happening here. So I think going forward, if you look at the equity statement, we want to see that those stock-based compensation don't result in more dilution for us as shareholders, as existing shareholders, because obviously valuation is still quite good at the moment as it stands. But going forward, if they keep diluting us, then even the growth that they will have will be negated by the fact that the additional shares are issued. In terms of valuation, it's very interesting. If you look at Yahoo Finance, the price to sales ratio at the moment is showing at 1.05, so 1 price to sales ratio. So you're paying exactly the price of the revenue per year for this business, leading to a market cap of 900 million only. So what that means is that if going forward you believe that they are able to generate profit, you are saying that you're paying right now one time the amount of sales going forward, assuming no further growth, no margin expansion anymore, no net income increase, no positive cash flow. This is what this number basically is assuming, because this is a number that you would usually get for a low growth, high maturity business that generates a lot of revenue, but not a lot of net income is going down. So if you believe that HIMS is some sort of business like that, then you're paying the appropriate price for it. Otherwise, you would see that this is vastly undervalued as it stands right now. And if we look at from a graph perspective, I've just pulled out that chart here. Ticker hasn't really updated the number; it's still showing at 2 point something for price to sales. But we've just been seeing that obviously when they have traded on the market, they've been valued very, very richly, and there was some sort of euphoria happening there. And they obviously also just IPO'd in the worst possible time when we had the hype growth season. Since then, we've only going down, really downhill since then. Now looking at a very attractive valuation for any growth stock with those types of margins and future growth potential. Price to sales of 1 is just ridiculous, right? So yeah, I do think it's a good deal at these prices. The market seems to pick up on it finally, eventually, but even at a 4.76 price per share, we do look pretty cheap still, because we're only adding around 100 million of market cap to it, leading to around a $1 billion market cap tonight, which is still pretty cheap for considering what the company has, in front of them, what growth potential they have, how strong the margins are, and how good the customer retention is that we've seen in the report. We are looking at a very good opportunity here today. Also to mention, although not that significant, we do have almost 8% of the shares being shorted. So I think all the small caps, loss-making, high-growth companies right now getting shorted by the day, heavier and heavier by the market. Obviously in February 21 we had this huge euphoria into anything that's growth related, money flowing into it, being very bullish on it, being very long on it. We have the bears doing the opposite now by shorting the stock and betting against it. Overall, I'm really happy with the results that HIMS and HRS has shown in their reporting. Nice revenue beat there, nice guidance and expectation for 2022. So we're excited to see what's happening there. If I had to call out any concerns, it's definitely still high marketing expenditure, but also the stock-based compensation that was hiding in other expenses, leading to a net loss for 2022, which is projected to be flat from this year. So that's kind of disappointing from that side. But since we show strong revenue growth numbers and strong gross margins, I do hope that over time we'll be able to get more of that to the bottom line. But for 2022, we gotta look out for those expenses. And I think Q1 will be an interesting quarter to see if there's any change in stock-based compensation, if this was just a one-off from 2021, and if marketing expenses change at all. If we see key metrics relating to that improving so that more and more dollars are squeezed out of every customer. I hope you enjoyed that today. Let me know in the comments what you do with HIMS and HRS stock, and see you next time, guys.